Morning all. You'll be pleased to know that this budget summary from Resort will be done well within the time that Rachel Reeves did to present hers. And let's start, if I may, with pensions. So Sean mentioned about leaks before, and I think certainly on pensions there were probably more leaks than Thames Water. So we knew a lot of the stuff before we even started that had been rolled out. For instance, tax relief, the changes to tax relief, they thought there might be a 30% band across everybody, and that might still happen, but we'll wait and see. The annual allowance, now Jeremy Hunt scrapped that in March, increased it in March last year. So you're now entitled to pay up to £60,000 a year into your pension contribution. It will be limited from your own salary up to that level, but if you've got a company and it has decent profits and you want to put a large contribution in, then that can now be £60,000. It was £60,000 actually for last year. I mentioned that because it is possible to carry forward unused reliefs from previous tax years. So just something to throw out there. The other thing that was, excuse me, Labour said that they would introduce immediately when they were brought into power was a lifetime allowance, but we knew a long time before that they weren't going to introduce that. So the lifetime allowance had been £1,073,000. It's not that long ago you could actually have pension funds up to 1.8 million, but bit by bit the Conservative government whittled that back to £1 million, and then inflation took it up to £1,073,000, and then it was capped there. Now that is still the cap for tax-free cash, because that was the one thing that we didn't quite know what they're going to do about in the budget. That was a rumour. Before the budget, Labour did through their Money Helper website did make an announcement that don't do anything with the pensions. We haven't made any decisions yet. It's not in our manifesto, and so don't make any hasty decisions were their word, and they were quite right. It wasn't touched, and as expected, I think, by the industry, it wasn't going to be touched. The thing that has been introduced already, and Phil touched on this earlier, is that pensions, any inherited pensions, are going to be, or death benefits are going to be subject to inheritance tax from April 2017. There is a consultation period. It started last Wednesday, and it runs for 12 weeks. That isn't so much the case, is it going to happen? Yes, unfortunately, it is going to happen. But more importantly on that, it's going to be a case of for people who are in defined benefit schemes, so probably public service, or those folk who have historically worked for companies who had final salary pensions, and that could all be dragged into the inheritance tax mix. Pensions, however, still remain highly tax efficient. You get tax relief on the way in, and your pension fund grows free of tax. And when you do come to take your benefits, there's a quarter of your pension fund, for the most part, you can take tax-free. So they haven't disappeared off the investment landscape. They're still very, very important. And Labour in their manifesto did say that they were going to do a pensions review. I think they're looking to do it in the next 12 months or so, certainly by 2026. And I think things about tax relief, annual allowances and lifetime allowances, which I don't think are going to change the last two, but I think a lot of those will be considered at that particular time. So we'll wait and see on the pension side. From the investment point, so I guess the golden rule with any type of investment is use your tax-free allowances first. So maximise your pensions, maximise ISAs before moving on to already things. Obviously, the big noise is that there's going to be changes to capital gains tax, but also in inheritance tax as well. And there are various exempt things you can do for inheritance tax. And AIM shares, that stands for the Alternative Investment Market. And these are essentially unquoted shares on the stock market for very small businesses. And it could be that if you'd invested in one of those, and after a couple of years, what you paid in was inheritance tax free. It's ran along the business property relief rules to a certain extent. They're still available. There's still inheritance tax schemes available there, but the tax rate's now being reduced to 50%, so it's a 27% tax bill on those when it was fully allowed before. However, those are high risk, as are some of the less risky inheritance tax mitigation vehicles. We've got things like enterprise investment schemes, venture capital trusts. They're not, for the most people, they're not suitable. They're just too high risk. But there are other less risky investments available, and our industry, the financial services industry, is pretty good at coming out with things to help keep the taxman's or tax people's hands off your hard-earned cash. Capital gains tax is, of course, a bit below for businesses and investors, and we all already know what the rates of those are going to be. And it also may change the investment landscape, because there's different types of contracts you can use to invest your money in once you've looked after your pensions and your ISAs. And I don't intend to go into a huge amount of detail, but some are treated as for income tax, they're investment bonds. Some are treated under capital taxes, so capital gains tax, which will be general investment accounts, or some might know them as collective. So shares, essentially, if you hold shares. So that's going to be a change. So from an investment point of view, that is likely to change the landscape. But we do have tools to help decide which is going to be the best route forward for you. So a very quick summary of mine.